Hi, good evening, everybody. Hello. Welcome to King's. It's great to have you. Thank you for taking the time to be here with us tonight. My name is Michaela. I'm one of the associates of the King's eLab, and our aim is to bring entrepreneurship to King's. So by you being here today, you're making that possible. So thank you so much. Today's event consists of two parts. One will be all about investing and getting funded, and the other one will be about your maybe new side hustle for entrepreneurship. We have some brilliant guests coming up. Thank you so much for taking the time being here with us tonight. And I'm going to hand over to our entrepreneurship in residence, the one and only Sheryl.
Thank you so much, Michaela. Good evening. Welcome again to King's Entrepreneurship Lab's journey into the entrepreneur's jungle. I'm just going to put this down. So I'm Sheryl Cuisia. I have the great honor of being King's first entrepreneur in residence. And as Michaela said, I am here to help encourage an entrepreneurial mindset by sharing my own experiences and insights in being an entrepreneur, as well as providing guidance, practical advice, and connections to help students succeed in their entrepreneurship journeys. So I'm making myself freely available to King students and anyone thinking about business. I'm here for you anytime, online or in person. So just to share my own insights and understanding, King's is the college of Alan Turing and John Maynard Keynes. King's offers a stimulating and forward-thinking environment to people from all backgrounds. It prides itself in its supportive, diverse, and vibrant community. Furthermore, King's has the highest proportion of undergraduate students from underprivileged backgrounds among all of the colleges of the University of Cambridge. So this understanding of King's values gave me much inspiration to devise a progressive and thought-provoking program that is inclusive and accepting of speakers from all walks of life. So basically, speakers who could share their individual stories of rising above challenges to become successful entrepreneurs, including within this houseplant world. And this is what we have for you this evening and what you may expect to see in many activities in which I am involved. So basically what we have for you is a fast-paced and high-energy event to serve this evening. We are covering a number of varied topics, so please do stick with us. I will begin the journey by sharing briefly with you my own entrepreneurship experience, and then we will dive into funding options available to entrepreneurs with a high-level summary of angel investing by the renowned investor and mentor, Modwenna Rees-Mogg. I will then hand over the microphone, so to speak, to successful angel investor Karin Schulte, who will join Modwenna and other successful investors, David Stredder and Mike Dennis, to discuss what they consider investable startups and businesses. And finally, as part of our Plantrepreneur Festival, we will meet three brilliant Instagram plant entrepreneurs. So Not Another Jungle, Tony, Pally Plants, Sophie, and local Cambridge gal at the Botanical Collector, Charlotte. So to give the Instagram plant community, including the circa 130,000 who follow Tony, Sophie, Charlotte, and myself, I do have an Instagram profile as well, the opportunity to also view the talk. We have extended Zoom invitations to members of the plant community. So I fully recognize that this event probably stretches the norm of what you would ordinarily see in a standard entrepreneurship program, but part of the reason I'm here is to help stretch your imagination just a little bit more to include offbeat or fringe activities that have the potential to become huge. So thank you for coming along on this journey. Okay, so I'm going to dive straight into a few things, if that's okay. So I'm going to tell you my entrepreneurship journey in 5 minutes, so I will speak very fast. So just bear in mind that every entrepreneur has their own chosen path. This is my own experience with the first company I started 10 years ago. So in quick terms, the key startup elements of my business were it was self-funded. I took what would have been a house deposit and used that towards starting the business. As I took no investors, I had the benefit of owning 100% of the company. So my customers effectively told me what they wanted, and and what to do. So initially, I wanted to create the technology that would cannibalize the specialist consultancy industry that I was in. And to raise the funds to do this, I would take on consultancy work. However, what actually happened is that our consultancy took off. And within the first month of launching, we won work on the biggest UK merger of all times. And then we continued to win more and more consultancy work. And we actually had no time to devote to building the technology. So we committed our time to consultancy. And then having successfully started up, I learned early on that structure, people, and standard processes were essential to nail down in order to scale up and grow. So I set up an advisory board to help with this process. And then finally, superior work leads to client loyalty and word of mouth. And because we did do great work, we were massively rewarded with loads of work coming to us via recommendations and word of mouth. So the business I founded in November 2011 and launched in January 2018 is a shareholder engagement and corporate governance advisory firm. It built on the foundations of something called proxy solicitation, which is a practice that comes out of the US of communicating with and rallying and influencing shareholders of listed companies into supporting the causes of clients who are either listed companies, activist hedge funds, or private equity firms. So in brief, my idea was simple. It was not new. My chosen approach was to take something that already existed and make it better, modern, and more intelligent. And that is what we did. So I named the business Boudica after the iconic Celtic warrior queen who raised the only rebellion against the Romans in 61 AD. And in 2018, after having advised more than 200 clients, Boudica reached an important milestone of being acquired by a FTSE 250 company, Equinity Group PLC, which is a purposeful financial technology outsourcing company that was formerly Lloyd's TSB registrars. So again, in contemplation, in my whole time at Boudica, I always had structures and strong beliefs that guided me, and which I think all entrepreneurs must have to be successful. So my first guiding light are 5 Ps. So I think we saw the 5 Ps already, but just very quickly: purpose, pitch, and difference, price point, promise, and process. So pretty much knowing what you would stand for. So Boudica's purpose was to win clients by rallying shareholder support. In terms of our difference, we prided ourselves on our fresh, intelligent, and tenacious approach to our work for clients. And then price point, we were never the cheapest. We were always actually on the high end, but guess what? We won the mandates, even though we were the most expensive, because we had reputation and kudos. And then in terms of promise, to maintain clients' trust, we always delivered on our promise, even if this did mean working literally 20 hours a day and weekends. And then process, to deliver consistently, we continuously developed our IP and established repeatable behaviors to become standard processes that the whole organization followed. And then values, what we were looking at earlier, basically, it is extremely important to have values that govern everything that you do. And when I thought about it in terms of the values that guided me throughout my time at Boudica, basically it's tenacity, the will to win, having a culture of care, for clients and for people, extremely important. And a culture of pride as well. So creating a stimulating environment where talented people feel like they can make an impact, and always being positive. Everything is possible. So problems are no problems. And personal accountability. We are personally accountable for meeting our commitments and progress. My view is that we are always in motion. Standing still is going backwards. So now that we have heard my little entrepreneurship journey, I'm pleased to proceed us to the next segment of our session, which will address funding routes for the entrepreneur. So I am going to hand over to Modwenna Rees-Mogg, first for a 10-minute presentation or a 10-minute chat, and we will go into a 20-minute discussion with my fellow directors of the UK Individual Shareholder Society, Karin Schulte, David Stredder, and Mike Dennis. Our audience will have seen their bios, but if each of the speakers could do a 30-second intro of your background, 30-minute, that would be greatly appreciated. And after the 20-minute discussion, we will open the floor for questions. Is that okay? Great, thank you. Modwenna, over to you.
Good evening, everybody. I'm currently based in Somerset, and I'm about to hide under a table before this hurricane hits my house. And I probably will have no internet tomorrow. So I'm delighted to have been able to be here tonight to see you all. I hope you're all thriving and well, and term is going well. I thought, as I've only got 10 minutes, rather than killing you with PowerPoint, I would just go through some key points, which I think are vital for catching an angel, but perhaps even more importantly, keeping an angel. I'm sure many of you who are on the entrepreneurial journey will know that one funding round tends to be like immediately addictive, a bit like crack cocaine, and it's very likely if you raise once, you'll raise many times. So the relationship you have with those early angel investors is going to be a long-term one, but you're going to need them in many ways, not just for the first round of funding you get. So I'll just sort of run through my points with you all, and then hopefully we can sort of discuss them during the panel session if there's anything you feel strongly about what I'm saying. So I think the first thing is the pitch. So that very first impression somebody's going to get of you, and that impression isn't just when you're pitching actually on the stage, it's indeed even in the room before the meeting or whatever else. And we now have a marvelous, easy way of doing a pitch, which is instantly understandable, which is you broadly go, hello, I'm X. This is the problem. It's big, perhaps why it's big, but also most importantly, here is my solution. The biggest single mistake I see entrepreneurs make is that they bang on and on and on about the product, and they don't take the opportunity just to be very short and sweet. This is the problem. Here's my solution. Can we talk? Get that right, and it may take you some time to get it absolutely pitch perfect. You will capture angels' interest, and also you are giving them, in doing that, a very easy way to tell their friends about you. So that's another critical reason why you want to get that particular thing right. The second thing, which I see a lot of entrepreneurs make a mistake, is this is a fundraise, whether it's angels or indeed VCs, it's a selling opportunity. I hear far too many entrepreneurs going, can I give you some shares for some money? It's never giving. I hope you're not giving your shares away. They're very precious. You want to be selling them. So you need to treat a fundraise, which is maybe one conversation with one angel, or it may be a very formal pitch. You want to be treating that like a military campaign in terms of preparation, and be thinking, if I was trying to sell, let's say you're raising 250 grand, if I was trying to sell a commercial contract for £250,000 as a startup company, gosh, what effort would I put in to getting that away? But I don't often see that level of sort of attention to detail and granularity with entrepreneurs, except for the best ones, and it's the best ones that are successful. So learn from them. So being absolutely on top of your game, getting all your ducks in a row beforehand. You have no excuse now not to have a data room sitting on Dropbox with all your documents. You have no excuse to be not keeping that updated all the time. You've no excuse not to have good channels of communication with LinkedIn and to be monitoring and recording what you're doing. Technology's enabled that for you, so use it to your advantage. I think the other thing that a lot of people forget is that angels in particular are real people. This may sound like it's obvious, but by that I mean they're people who have had great success in life. They know a lot. Typically, they have made their money by working very hard. So sharing that money with your company is something where it's their money, but they know what it's cost them to get there. Very few angels have inherited, relative to all angels, very few are people with inherited wealth. So you need to be thinking, how would they think about, or how would they have approached this? So treat them like a real person. If you do that and you can get the relationship right, everything else will fall into place, because they are going to back you because they trust you. They think that their judgment might just be right, that you're the one who's going to make it. And if you play that game properly and sincerely with them, you will find that they respect you, and not only they, but their friends and more will come towards you to help you. How many angels are there in the UK? Well, there's a lot more probably per square centimetre of Cambridge than there are in other regions in the UK. You've got the very successful and rather marvellous Cambridge Angels in your gang, and there's Cambridge Capital Group as well. And clearly the sort of London market and the home counties markets or north of London often have their eyes turned towards Cambridge. So but there are probably about 10,000 angels in the UK. There might be many more people who will back their friends or might get involved in a sort of angel type investment, but they're not necessarily what I would think of as an angel who is really consciously and professionally scanning the market to make investments. Of those 10,000, to give you an idea, angels will typically invest between 25 and 50,000 in a company. The very few big ticket angels will put in 50, 100, 250,000 or more. So depending on what your fundraising need is, will drive how many angels you need in your business. A typical angel makes between 1 and 3 investments a year. So you can see that it is a bit of a tricky game. There's not that many of them, and they aren't making that many investments actually overall. So to snare one, you need to really be the top, the cream of the crop. But there are now angels. I come across angels, literally in the villages near where I live. And they are the most, I still and continue to think they are the most special human beings that exist on this planet. Their capacity to be smart, generous, to help you make money so that they'll make money is an extraordinary type of personality and attitude to have inside yourself, and they should be lauded and feted in my view. Just to give you an anecdote, my favorite angel story of success, I'm going to just tell you a number of how much they invested, and I don't know whether, Sheryl, we can get the people in the audience to shout out or maybe put in chat what they think the return was. So the investment was £12,500. So would some people like to have some guesses about what the return was when the angel exited?
$1 million?
Can we do something on chat or whatever? Sheryl, do you have a system for that? Oh, we've had some people are doing it on chat. We say 1.2 million, 100,000. Oh, no clues about who the company or market is. No. You just have to, this is a bit of fun. Just have to give me a number. Oh, I've got 5 million. You're getting closer, guys. Now it's getting colder. Is there anyone in the room who wants to shout out and tell Sheryl, who could tell me?
10 million.
How much?
10
million. No, you're still way off. It was 127 million pounds. Now, the point is that wasn't just one investment the angel made. The actual that angel had made 85 investments. So it can happen, but and that's of course what angels, the big dream is that sort of type return for angels, literally hundreds of times your money. What do angels want from you lot? It's quite interesting what they want. They clearly, there's the sort of making money. There's often the sort of doing good, giving back. But what I actually think many of them want deep down is that they want to prove that their judgment of you and their trust in you was right. So if you think about when you're engaging with somebody who's going to invest in you, and you think about those sorts of issues, you will find that you actually align quickly. The worst thing I see is people treating angels as checkbooks. They're not checkbooks, they're people. So what else do they want? They do want to help. I surveyed a gang of angels the other day, and it was quite shocking how many of them said that after they invest in a company, they pretty much never hear again. That is, from an entrepreneur's point of view, that's just such a stupid way to behave. You've taken in this sort of expert money, with these incredibly clever, well-connected people, and you don't bother to have a relationship with them afterwards until you need more money, and then you ring them up out of the blue and say, can you cough up some more money? I mean, that it's just an irrational way to behave. So if you're going to seek angel money and raise it and close the round, remember that that is the start of the journey, not the end of the journey, and have a think beforehand about how you're going to look after and care for that relationship. Clearly they want to make money. I've given you an example of the sort of returns you can get. A group called Investors have just produced some research saying the cohort they've examined are getting 14.4%, 14.7% IRRs. That's pretty good. In really good times, we would want that to be more like 27% IRR. So, you know, we are into this really big, ambitious, high growth stuff. There is no point in being an angel investor and investing in something that never goes anywhere, because actually the returns come from the sort of unicorn type companies. So the other thing is they are absolutely inundated as angels. So you will, if you put your head above the parapet and say you're an angel, you will be approached by loads of people on social media, direct, through friends, through family. So you need to really stand out. How do you stand out? The biggest way to stand out is to show that you're ahead of where they would expect you to be. So you want to basically be impressing them with everything you do. So if you think, I don't know, it's about getting customers quickly, make sure you've already got customers and more coming before you talk to them. If it's about building tech, don't say, oh, I can't build my tech till I have your money. Go and have a go at building the tech. Communicate. They are real people. I'm going to reinforce that. And in terms of getting you and them what they want and you want, my three things are focus, execution, and timing. I think that's just over the 10 minutes, so I'll stop. Thank you very much, everybody.
Thank you. So we'd like to welcome Karin, Mike, and David to the panel to join Modwenna for this discussion. So, Karin and Mike, maybe a 30-second introduction on your investing journeys.
Yeah, so my name's Karin. I lived and worked in Asia for 25 years where I was a private equity fund manager. And I had the wonderful opportunity to invest on behalf of the fund in many different types of businesses and see how they grew. And personally, after that, I then did my own investing, not only in private equity, but also in listed equity. And since I moved back to the UK, which was about 8 years ago, I joined ShareSoc, which is the not-for-profit society of which Sheryl is chair and of which Mike, I, and David are directors, which sort of empowers individual investors in the UK, more typically in listed businesses and companies listed on the stock exchange, but also more generally trying to improve financial investment education in the UK, which is somewhat sadly lacking. So I do invest proactively in smaller businesses myself. Maximum I would do would be about 1 or 2 a year, and I'm very happy to talk more about those.
Excellent, thank you. Mike?
Thank you. Yeah, my name's Mike. I very different sort of background to Karin. I actually studied engineering here many years ago, longer than I'm prepared to tell you. At Christ, and went into the oil and gas industry and various other heavy process industries as an engineer to start with, and then learned a little bit more about how commerce works, got involved in selling and marketing and all the other attributes of a large organization. So I did that for my whole career and didn't spend any time at all investing because I was too busy doing other things. And all the surplus cash I had went to an IFA who invested it for me. And I didn't worry about it until I retired early in my early 50s and decided to do something else with my life. And I actually looked at the reports that my IFA was sending me and realized that he was making more money out of my investments than I was. So I decided it's about time I understood this investing world a bit more carefully. And I actually had a colleague at work who recommended I join ShareSoc, and so I did. And the rest is history. I ended up being on the board as well as Karin. So my investing journey really only started about 8-9 years ago. And I can't claim to be an angel investor at all, actually. So I'm sort of a bit of an imposter, but I've done a lot of investing in smaller listed companies on the stock market. And some of the attributes are very similar. So I've gone up a very kind of rapid learning curve. Many of the things I've learned are from my fellow members and directors at ShareSoc. So I'm a much more clued up person now than I was 8-9 years ago. I manage my own portfolio and I enjoy the investing. I don't want to make it my only thing because I have time for golf and things like that as well. But I do enjoy looking at companies, trying to understand them. You know, having worked in the world of commerce for a while, I quite enjoy looking at smaller companies and trying to understand how they operate and where their strengths and weaknesses are. So, and we do a lot of that within ShareSoc as well. We actually have companies, directors coming to us and pitching to our members.
Wonderful. Thank you, Mike. And last but not least, David Stredder.
Hi, welcome everyone. And I had a different journey to most, I guess, because I was adopted and my parents wanted me to be very independent because they were quite old when they adopted me. So I tended to look after my finances from a very early age. And luckily, I went to a school where the economics teacher was very keen on getting us involved in commerce and looking at shares in companies. We entered a competition in the sixth form and our school, our team came second. It was a national competition run by the Daily Telegraph. And that got me hooked. I was so keen to understand companies and how the shares went up and also how they went down. So that had me, you know, concentrating and investing from a very early age. The other thing that I was one of the founders of ShareSoc, and the other thing that I want to get across is that it can be quite lonely when you're investing completely on your own. So it's really good if you can join in groups, and of course groups of investors getting involved in companies is a good way to start. So I set up not only ShareSoc, but also I wanted to run a whole host of events for investors to meet up, network together, and that's called Mellow. We run virtual events at the moment, but we will be running a live event in London in May. So, you know, you're all very welcome to come to those. I think it's good if you can get together with others and share your views on investing. It's quite an isolated engagement, if not. And you really do have to cope with the downs as well as the ups. Every investment won't go well. It's just not possible. There will be some real difficult ones that you'll get involved in. But certainly as far as if you want to set up your own business or be an entrepreneur, I think it's really important that you make sure that you know absolutely everything about the sector or the product that you're going to operate, and make sure that you really have a very more P's for you, really be, you know, passionate, personable, and positive in what you do, and investors will get to like you and how you're operating. The best investment I made was actually many years ago, about 20 years ago, a product that just about everyone in here has probably seen at some point. If you've been to a theme park or been to a leisure centre, I think you've probably by now used one of the queue saving devices. It used to be called a queue bot. It's now an app on your phone. So you could go to Alton Towers, Thorpe Park, wherever you go. If you don't want to stand for an hour in a queue, you could actually have a queue saving device where you would literally have a virtual queue, so you didn't have to stand and stay in a queue all day while you're waiting to go on a ride or an activity. That meant you were free to go around the park, which is a win-win for everyone. The park gets more money out of you because you're not stood in a queue. You can go off and enjoy a restaurant or whatever you want to do. And that was set up by a grandfather who took his grandkids to a theme park and spent 5 hours in queues out of his 7 hours of the day and thought it was ridiculous. Didn't enjoy it. The kids couldn't have ice creams because they were stood in queues. And he came to the investors and said, I think I can create something that will beat these queues. And that's what he did. So I invested when they were 10p a share. They're actually a listed, fully listed company now. They're £9 a share at the moment, but they've actually been as high as £29. So that's quite good from a 10p or so, 7p start, I think. So a little bit like Modwenna's one there, you can really have some very, very big gains if you hopefully back a good idea and a good product and good people. The people are important behind it.
Yes, David, that's an amazing 30 seconds, and you've taken some of my questions as well.
Sorry.
Fun fact about David is Emma Raducanu plays at his club.
Yeah.
So claim to fame, David. So we're going to ask some questions. Okay, so if that's okay, and then we'll open it up to the floor as well. So first question is maybe Karin, you can start. Why do you invest in startups?
Yeah, it's a good question. I mean, we have to associate startups with high risk. So I think it's very important that individuals appreciate that angel investing can be quite high risk investing. I quite like a portion of my portfolio being quite high risk. I like ideas. I like new ideas, I like new concepts, and I like investing in individuals who I think can make those concepts happen. And so that's what excites me. And I don't go on the journey particularly hand in hand. I don't expect to be a management to the companies that I invest in, but I do, as we were saying, and to, you know, I do have some information that might help, and I'm very happy to share that.
Great. Modwenna, did you want to share your thoughts on that?
Yeah, I've had an interesting journey for the last few years. I did some angel investments when I first stopped being. I was a banker, and then I ran away because somebody proposed to me on the first date, so I married them. So never, ever do I accept a discussion about risk from angel investors, because marrying someone for the rest of your life on the basis of half an hour is crazy risky. Luckily, it worked. So I made some angel investments. And back in the day, I thought it was about sort of backing what I understood. And then I realized actually it's not really. It's about the degree of trust and the degree of control you have. And those are two more important metrics, I think, than actually sort of understanding the market. But actually, since then, I then became an entrepreneur. So I did it a bit the wrong way around. And in fact, twice now I've had angel backers, which has been really interesting, sort of working on the other side of the table, as it were. And my experience is that it's all about the people dynamics. Amazingly, one company where we took in some angel funding, one of the angels, I never met them at all. You know, they put in their money, they were a friend of my co-founder and didn't bother, which always astounded me, because why would you do that? Not to know the people, because I think part of the joy and pleasure of angel investing is knowing the people and going on that journey with them and sort of showing you can help. The angels, so in terms of sort of current angel investing, I'm more talking sort of on behalf of other people I know. There are some headwinds. You know, we've got this storm coming into the southwest, but I do believe there's going to be storms coming into the angel market. I think we've never really, the angel market in the UK started getting going in the 1990s. So basically, the modern angel market in the UK has never suffered from inflation, and I think that's going to have some really serious ramifications. But the best angels will absolutely just sail into the storm and win, because those who take the risks, when, you know, whether it's blood on the streets or whatever other sort of expressions you want to use, that's when you win big. So actually, the ambitious entrepreneurs who seek out the ambitious investors will make very, very big.
Good. Thank you, Modwenna. Mike, I think this was a question for you as well as for David. So how do you decide what companies to invest in? So you invest in smaller listed companies. I think
Yeah.
David has a dragon dance style activity that he undertakes. So, so you start first, Mike. Tell us.
Okay. Yeah, well, as I said earlier, I tend to invest in listed companies. So they're far more mature at that stage. If they're already on the public market, they're no longer in need of angel investment as such. But when you're talking about small companies, I always think, and a bit like angel investing, it's so much is down to the management of the organization at the end of the day. So a lot of the things that I still look at with small companies is, the quality of the chief exec or the chairman or whatever. And I quite like actually meeting them and listening to them present and asking them questions. And it's very good in a room actually with a whole bunch of investors where they may pitch to them a bit like you would with an analyst meeting in the city, because everybody will come at it from a different angle. So you get to understand a whole range of things through 360 degrees about the company and the individuals who are running it. So I'd do that. I'd look around at the background of the chief exec and so on and so forth. Because you do find with smaller companies as well that, there are often different motivations. There are some I can remember in my past who have come to present to us, and I didn't realize, but somebody was doing the digging on, as you do with Mr. Google, and found out that, and found the chief exec's Facebook account and lots of stuff like that, and started digging into the accounts and realized that over the last 10 years, the company had hardly made a profit. So the investors have got nothing out of the company, but she had paid herself over the past 10 years, £5 million. And when you think about the balance there, you're thinking, well, we're putting all the money in. You seem to be taking it all out and no profits are being made, or very few profits, less than 5 million in 10 years. And those kind of things, it's useful, to understand who you're dealing with, and that would be what we would class as a lifestyle company. In other words, the investors are funding the chief exec's lifestyle, and that's really not the kind of company you want to get into. So I start with the people running the show. It doesn't matter so much if you're talking about BP or Shell or HSBC. They're big, very stable organizations. You can put a monkey in charge for a year and probably nobody would notice because they've got some very good executives keeping the business going. But you cannot do that with small companies.
Okay, interesting. We'll tell Bernard Looney that.
Yeah. Don't tell him I said that.
David Stredder, maybe a minute from you.
I totally concur with Mike. It's so different when you're looking at smaller companies to large ones. The situation when you meet the management is always important to get a feel for how they act when they're looking after the finances. I like to see certain types of FDs if I can when I'm investing, that are sensible with the money and not splashing it on all sorts of ridiculous things. And just generally, I think it's good if you feel that they're passionate about what they're doing as opposed to passionate about making money just by itself. I think, it's good if they're creating wealth for everyone rather than just themselves.
Yeah, I'd just like to add, I always like to think about if I go in, how am I going to get out? What are the ways I'm going to get out? And what are the ways the business is going to grow and how the founder is going to get out and how they see themselves growing with it? Because I think that can be an issue with smaller companies and the founder being there and perhaps not growing always in the way that you may like. So
Karin, you think the founder should always get out? Like I got out.
Yeah, I think you have to judge it against this people perception of how you believe those individuals will grow with the business and can they grow and let go of some things in order for it to grow better, actually. And I think that can be a challenge, but I always like to think of the exit as well, not only for me, but for that business and for.
Modwenna made a point about sharing. So if you're going to have investors, you're going to give some of the share of your company. So I kept 100% with my company because I got good advice from a financial PR. Karin, keep the money yourself. That was an Irish, but But so under what circumstances do you think and entrepreneurs should seek out angel investment? Maybe we can start off. Who wants to start this off?
Yeah, I mean, I'm happy to go. It obviously finances and acquiring cash for growth is important, and then you have to think about how much are you prepared to actually sell of your business and control, and how much you want to keep, and thinking of future growth, future fundraising, and educating yourself a little bit about how that works. I think is important at the start, so that you can understand how the company and the business will grow, and how much money you may need, and how much money you may need to fundraise, as Modwenna said in her overview. And I think that can be something that can be a little bit tricky for people, because it's not necessarily a part of the business that they're doing day to day. But that's why having an entrepreneurship lab and an entrepreneur in residence like Sheryl, that you can talk to about those kinds of things is fantastic, and really sort of the discussions you should be having if you want to think about attracting investors, or even being investors yourself in the future. These are things that you need to bear in mind.
David, Mike, Modwenna, any thoughts on that before I open up to the floor for questions?
I suppose I've got a couple of thoughts, which is you will always need more money than you think, either because it's taking longer or it's going better than expected. It always takes loads longer than you think. I think something that we as an industry should do more of, and I think it will start to emerge actually with looking at things like PitchBook and stuff, where actually there are some informal rules about how much it costs to get a company going. So I've got some angel friends who always say it's £1 million to get a SaaS business to a point where it's sustainable. So how you take in the £1 million is can vary from take it all up front or take it in small tranches. The thing I would encourage entrepreneurs, I'm assuming most of the audience is entrepreneurs tonight, is always think about the end game, not the beginning game. Always remember that every round of investment can be a renegotiation. So I've got an entrepreneur friend who's just negotiated himself back from 18% to 35% of the company. So even though he'd been diluted a lot, he said, well, actually now I've proved it. I want a bigger stake in the next funding round, and he got it. So it's always about thinking about the exit. And my last point, I suppose, is remember, once you've sold those shares, they're jolly hard to get them back again. Even if angels want to get rid of them, often it can be quite hard because of the way the deals are structured, particularly if VCs are involved, for you to get your hands on them. So sort of think about that issue, that you're probably going to be effectively commercially married to these investors for possibly 8 to 15 years. So I know sometimes it's like one's just desperate for money because one thinks that's the only answer. You can nearly always get things at cheaper prices than you ever thought possible. I always negotiate everything if I possibly can, on the grounds that I'm a wonderful entrepreneur, and but actually what you need to care about is your percentage shareholding on the day you exit. So well done to Sheryl for hanging on, that's what I'd say.
Excellent. Anything to add, Mike?
That I can think of. I think that's a pretty good start.
Yeah, I agree. Why don't we open up to questions on the floor?
Yeah, so I have a first question from someone online. The question says, if an entrepreneur who is not registered as a company wants to get investors invested from angel investors, should they first register the company, or should they first borrow money, something like in the form of convertible notes, and then register the company? And then the second question, how often do you find owners of startups that want to grow the firm in long-term businesses rather than sell out after a few years?
So it sounds like an MBA student.
Yeah.
Okay, who wants to tackle this?
Can I have a go at the first one? Because it's actually quite important. So you do need to register the company so the angels can buy shares. If they're not doing that, you're actually selling a future, which is a complex financial instrument, and there's some regulatory issues you should start worrying about right now, because selling complicated financial instruments is a specialist regulated activity. So be careful. But it costs about £50 to register a company. So get the company registered. And by the way, the minute you've registered the company, make sure the website gets transferred, the ownership of that website gets transferred into the company.
David, do you want to take a stab at the second question?
I think it's a mixture, to be honest. There are, naturally, you can ask the question of any entrepreneur when you're investing the money, and they'll more often than not try and convince you they're going to give you an exit that'll be 35 times the money you're investing in only a few years. But it never ever works like that. You know, some are a lot slower than they expected. Some don't have an obvious exit at the end, and they decide they want to just keep the business growing and maybe pay out dividends instead of actually having shares that can be sold. So, you know, it's different when you're in a listed company because there are exit opportunities. You can sell your shares in the market, but in private companies, it's not quite so easy to do that.
Go ahead. I think we have.
Can you hear me?
Yes.
Yeah. So I have my question will further deep down on the exit kind of question. So I want to know a little bit more about as angels. Generally, you're not as strong, especially when the VCs come in and they don't want a lot of people on the cap table and whatnot. So what do you recommend generally? Should angels drop out at Series A, Series B, or should they hold on to like till the company gets listed? And what's the recommended, like, should they go for an ecosystem play, cash out and invest in other startups, or should they just hold on to the one if it's successful? And generally, what is the round in which they exit?
Good question. Karin?
Yeah, I think it really comes down to the individual angel, to be honest. I mean, they may want to, you'll have other rounds, you might have venture capital companies. You think, yeah, I'm happy to keep with this. I'm happy with the way it's growing. This is what I want to see. I can see a future exit down the path and stay in. Or perhaps, it's got to the stage where you think, yeah, I'm making enough return. Thank you very much. And I'm happy to take my money out, or at least part of my money out. Of course, you don't always have to exit 100% necessarily, and put some of that money somewhere else if you want to continue doing angel investing or diversify your investments into other asset classes. So I think it's hard to have one generic answer to that question, but it depends on the angel that you have. And that's why, as Modwenna said, you should really know your investors, because you'll probably have an idea, if you know them well, how they will react.
Would it be fair to say, I don't know that many angel investors, but that most of them have only got a relatively small proportion of their investments in startups, that they manage their profile in terms of they'll have a lot of other investments in more mature and more stable areas. They won't put all of their wealth into just angel investing. So they'd never expect to be able to, they haven't got the liquidity in that kind of end of their portfolio, and they recognize that. And it's almost, they would never dream of putting more than sort of 20% of their worth into that kind of market.
Yeah, I mean, I can only talk from my personal experience. I'm not putting 100% of my wealth into angel investing because that's too high risk for me. A portion of it is going in, and then I will manage those and those investments as I see fit. So an opportunity to exit, if a VC comes in and the deal is structured that way, that might not be structured that way. There's many ways to structure these kinds of rounds of investment. Would be something that I would look at, and others too. So it all depends on how long you think there is another opportunity to exit, because they aren't listed companies, so it is harder to exit if you're an angel investor.
One more question from the floor or online, please. On the floor, passing the mic. Hi.
Okay, yeah. Thanks for this speech. My name is Valentin. I just have a question. If you were on the other side of the coin and you're an entrepreneur looking for investors' money, how would you evaluate the investors? And are there any traits you would look out for where you want to avoid this investor? Because I feel like a lot of companies just accept money if someone says, yeah, I'll give you 50,000. But some of the investors can actually destroy the company as well by micromanaging or being too invested emotionally in the company or wanting the company to pivot. Are there any traits you would look out for when speaking with investors?
Good question.
What do I think? I think this is what I was talking about in the sense of personality. So I think no decent angel will mind you doing your due diligence on them, and you should. So I think it's understanding, and sometimes I think entrepreneurs think it's all about the angel interviewing the entrepreneur, but actually the entrepreneur should be interviewing the angel as well. And also the other thing where you can help both expose potential issues but also address potential issues is in the shareholders agreement. So that's another thing. I mean, my experience is that if you treat investors really well, they will tend to treat you even 10 times better. The entrepreneurs who I hear about getting into trouble with angels is because they don't treat the angels with respect. And that basically winds up the angels, who then start using their power to be a pain.
Great. Sorry, Karin?
Yeah, just very quickly. So for me, I need to believe that the individual can make it happen. And I like to see that something has already started to happen. So I'm not investing in a concept. I want to see that the individual has really started down the track of making that happen. And there's a lot about trust, but also about the network and the connections that that individual has in that area and who they're bringing along with them, whether it's as an advisory level or just within the industry. And those are things for me that I really am interested to understand more about at a very fundamental level to even start a conversation.
Very good. We've got 2 more questions apparently from online. Adam. Oh, how polite. You can throw it.
So in my experience, early stage revenues are like a surrogate capital, which can help to reduce the extent of dilution as a result of external capital raising. Would the panelists comment on their views on this, even if it means changing the focus for a while until you reach break even? Probably MBA student again.
Yep. Who wants to take this question? David? Mike?
Probably better on with David or Modwenna, maybe.
Personally, I think revenues, if an early stage company has them, it's a big bonus. So many of them are, finding their feet. So, it just depends on the type of business, whether it's a brainchild idea or whether it's something that can quickly be put into action. Revenues don't always follow quickly, so sometimes you've got to invest more before you actually get there.
Anyone
Oh, sorry.
else?
I was going to say, I think making revenues in a company is like your first paycheck, when the first time in your life you go out and earn your own money and it's yours to spend. That's how I see revenues. I completely agree that it's a way of preventing dilution, but I think that's the wrong way to think about it. The point of running a business is to sell something for more than it cost you. It's that simple. Do it. That's why you're existing. Too many companies become fundraising junkies. The only exception to that is the rather unusual breed of sort of, not necessarily Facebook social media platforms, but there are certain industries and characteristics where actually it's vital never to sell anything at all, because the buyers, if you sell anything at all, if you're planning to sell someone like, I don't know, Facebook, they might just want to do eyeballs or whatever the measure, the KPI is. And if you produce sales, what you do is you put a price on the value of those eyeballs. So you actually, you put yourself at risk in terms of maximizing your exit. So there are a few scenarios where you absolutely positively don't want to sell anything, but those sorts of opportunities, you need to find the investors who understand what you're doing, and will help you get there.
Perfect. One last question.
From the floor, and then after the event you can definitely ask in person.
So what's the impact of domain expertise on making the right investment decisions, especially in the space of emerging technology?
Just repeat that for me again.
What's the impact of domain expertise in making the right investment decision, especially in the space of emerging technologies?
You mean from entrepreneurs?
From investors. So investors investing in AI solutions.
What expertise?
That they will be bringing to the investee company.
So, for example, there have been, I guess, scandals from lack of due diligence where someone has promoted a solution as an AI that will solve the world problems that has ended up being 5 lines of JavaScript.
Okay, yeah. I mean, that is all about doing the due diligence and asking the right questions and understanding the business as much as you possibly can. And I think that's important. And that is also, again, it is very much people-based and meeting the people involved and asking the right questions and getting the right type of answers. And if you don't understand something and you can't get to an understanding situation, Houston, we have a problem. And I think everything should be understandable. So yeah, it's about due diligence.
So you don't value the importance of domain expertise? So an investor that has a background in machine learning, for example, would be able to make a better investment decision than someone that doesn't have that?
From an investor perspective, if the investing company is trying to match an investor who has an expertise in their area, of course, you're going to potentially get a better match because the investor is going to understand more about that business sector. So yeah, I absolutely agree. And they can go deeper and they'll probably have networks in that industry, in that sector that are going to benefit. And that's definitely something to target. Absolutely.
I think you two should have a chat next door.
I always think of it, if I don't understand what the company does and they can't explain it to me, and I'm not stupid, so I generally pick things up, then I don't invest. It's as simple as that. Because either they're stupid or I'm stupid or the thing doesn't work, it's a fake, or something. But either way, you don't want to invest in it.
Well, guest speakers, incredibly intelligent and stimulating conversation. Thank you so much for the discussion on angel investing. Could we give our speakers a round of applause?